Hello everyone and welcome to a new ATFX video. My name is Gonzalo Canete and this is the summary of the week. If you're watching this video, it's because you want to check what was the major events happened during the past week and what was the effects on the market. I'm gonna recap for you every single event happened during the last week. I'm recording this by the end of Friday evening, so you're gonna get everything super fresh. And unless something happens during the Saturday or Sunday, probably geopolitical events in worst case, market information is summarized all in this video. So welcome, find your place and let's start. Just a quick reminder, I'm always posting every single thing that is going on our channel on ATFX Connect. So if you go to ATFX Connect on X, on the platform X, you will also find the charts I'm setting, the TV interviews I'm doing during the day, and the last perception comments strategies that I can find on the market. Also, if you want to review morning news, a morning summary, I'm publish every single morning a summary of the day, of the last 24 hours in our blog ATFX Connect. You go to the blog section, market snacks, and here we go. Now let's go to the point and let's review the calendar. Today, Friday evening. During this Friday, the last event, the last most important event, it was obviously the employment report, non-farm payrolls and unemployment rate. Now what happens is we got the non-farm payroll, super good, super positive. It was 275,000 over 198,000 expected, which means there are more jobs created than expected. It means like actually the unemployment rate should decrease based on these numbers, but as we were mentioning in our TV interview, somehow it's a contradiction that unemployment rate is keep dropping. Non-farm payroll is rising while the unemployment rate is dropping, but we have seen for the last, I will say the last year at least, that these two numbers published every Friday, first Friday of every single month. These numbers actually are always reversed, which means like if we got a positive NFP, we got also usually a negative unemployment rate, or vice versa. If we got a good unemployment rate dropping below the expectations, for example, then NFP is actually not as strong that we were expecting. So in this case, my feeling is they do this to just try to neutralize the effect, the impact of this data on the market. As you can see, also the reaction of the market was we got in this case a dollar dropping, the gold is rising, euro dollar actually was just the first minutes after the data was just touching even 109.80, as you can see there, but clearly a few minutes later it was just keep dropping below those expectations. If we go to the charts, you will see that actually what we have been facing, it was, let me open the other one, it was a SP500, a equity market in US, rising super high with new records. Take a look on this chart. You will see actually we are watching the mini SP500 and we can see that it's breaking out every single new level that we are facing on the index. It's amazing. The evolution of the price is crazy. I mean, take a look here, but you can see that the price is just keeping rising and is breaking up new records in every single season apparently. And with this data, with increase on unemployment rate to 3.9, which that's the number, the expectation was 3.7 unemployment rate, and the final number was 3.9% of unemployment rate in the United States. Therefore, it means that in theory, the labor market in United States is getting weaker, which is something that the Federal Reserve has been expected for the last few months. If you don't understand what we're talking about here, you can go into details, because in every single report for the last couple of weeks, I have been insisting in this point. Federal Reserve only can reduce or cut interest rates if they see that the labor market is getting weaker. Why? Because the main precursor, the main factor that is keeping inflation stuck there, and as a proof of the inflation is getting stuck, I'm gonna show you also certain numbers. We can go to trade economics. We can actually check what is inflation rate right now in the United States, and you will see for the last, since November, even taken in consideration since June, since summer 2023, the inflation rate has been dropping and rising and dropping and rising and dropping and rising. For example, the last one, It was 3.1% inflation rate in January. If you take a look, it was 3.1% inflation rate in November, and it was 3% in June 2023. So therefore, we are not moving so far. We are making a kind of, let me draw it here, lateralization movement. Here we can clearly see that the inflation was decreasing, but in this one, we clearly see that the inflation is getting in a kind of lateral movement or range that is not going nowhere. This is the main concern of the Federal Reserve, and they know that this stick inflation is probably caused mainly by the pressure of the salaries, of the wage, and they know that therefore, if the service sector is the one that is pushing high inflation, which is the, I was mentioning in the report this week, actually, the disaggregation on inflation, how it's composed, and I was showing to you clearly here with data, macroeconomic data, that the one of the factors inside of this inflation is the service, which is still rising over 1% monthly, 1 month to another, is the highest one in the inflation factors, and therefore service is one sector with high volume of labor force. Therefore, it's a lot of people working for service sector, and only when the labor market start to reduce the size is when the service probably is gonna start to reduce the pressure on inflation. And then they're gonna give open path, green light to interest rate cuts. Regardless if that happens or not, what we can see is the market is celebrating those numbers, the market is celebrating that effect, and as you can see, the market is actually happy with the data so far. It's true that also we have seen the last few hours, couple of hours, 2-3 hours, that on the spot, SP 500 has been dropping a little bit. Maybe it was expected even weaker labor market. Maybe it's not enough. We can even go and check if there is a new comments, but I don't see anything new so far. We got certain comments from Janet Yellen, the Secretary of Treasury in the United States, the ex-president of the Federal Reserve. She say there is no evidence of inflationary pressure coming from the labor market. No evidence of inflationary pressure coming from the labor market. But Waller from Federal Reserve has been saying the opposite. They say, they has been mentioned many times, I'm quoting, that the labor market is so strong and therefore there is no urgency to cut the interest rate. This is something has been said too. So yeah, so far I will say that if we take a look on the market, a quick review, this is the SP 500. We also see that the Nasdaq is dropping for the last few minutes, but you need to take this in the context, in the right context. Take a look, come on. On the long term, we are breaking new maximums every single week. So even if today, the last few hours is just dropping, the fact is the market is highest than ever. We are right now on 18,071 points on Nasdaq. If you go to Russell 2000, we're gonna see that actually it was in 2,085 points, while Russell 2000 is one of the most cautious index. Comparing with SP 500, comparing with Nasdaq, you can go to Russell 2000 and to see what's the behavior of the small and middle caps, which they are the ones, the more realistic ones, compared with the all stars in the SP 500 Nasdaq. From European side, we also got the DAX, which is still so strong, and again, it's dropping for the last couple of hours, but overall, it's in a new break, a new record. Since this week, has been pushing highest and highest, forward and forward, just going straight away to 18,000 points. And we are almost there. We are registering today a new maximums on DAX that reached 17,874 points on DAX 40, the biggest German European index. I also mentioned, I think it's on ATFX Connect 2, a very interesting fact. This chart, I was just reading on Bloomberg this morning, and I saw that EUROSTOXX, in terms of returns so far this year, EUROSTOXX from Europe, the index from Europe, has been overpassing the SP 500 in terms of returns. Something that is incredible. Why? Because if you take a look, the growth rate from European area is nothing, is zero, is none. But if you take a look on growth rate on United States, is much stronger than that. Therefore, my question is why the European area, the European stocks are keep rising when the economy is actually imploding, is closing businesses, and somehow this reduction on GDP, which is a reduction on goods and services, gonna obviously be or result in a lowest or worst earnings results for the main companies in Europe. So why and who is investing in the European stocks? Very interesting point and very interesting reflection. Think about that. Despite the lack of growth in Europe and the absence of rate cut promises from European Central Bank, which is something they discuss. We have here in speculation yesterday. This is another second event important this last week. It was the Central Bank Europe decision. They keep on holding interest rates. Christine Lagarde suggests that maybe in the future, based on the data, they could cut interest rate, but it's something they are not discussing at the moment. So therefore, the only ones who are openly talking about cut interest rates is Jerome Powell, the head of the Federal Reserve, and the European Union. Despite they are not considering the interest rate cut in short terms, the European markets are keep rising to a new maximums even when the economy is in contraction. Something smells super weird there. So keep an eye on that and pay attention on the coming charts. Which means that we also should take a look on euro dollar. This is the chart I was sharing to you in the previous videos. And we were discussing the fact that euro dollar mainly probably could not break out this area and will start to keep dropping in this direction because dollar was getting stronger. However, what we can see is that the market is not responding to these rational factors, that the rational factor of US is a strong economy while European Union is dropping. It doesn't matter, euro is still keeping stronger against the dollar for some reason. And as you can see, is rising to 109.40, and again it was making a kind of micro flash rally just when the unemployment rate was released. So keep an eye on this too. And gold has breaking up new records during this day, the new maximum of $2,200 per ounce. Super interesting. And on the other hand, we got Bitcoin also, which is rising and touching new maximums of $70,184 per Bitcoin. New record. Incredible. What is going on with Bitcoin? Oil is dropping. It's interesting to see how dollar is dropping while gold is rising and oil is dropping. So very suspicious too, because usually commodities, the reaction and adjustment between gold and oil to the dollar is actually the opposite. So if the dollar is getting weaker, as we have seen, gold is rising, oil should be at least moving upwards just a little bit, and it's doing exactly the opposite. So again, today we are watching a very strange market, and some of the movements that have been done during this Friday probably gonna be correct during the next week. So I believe that some of these movements are actually a trap, are not the right movements of the market, and the next few days, the next few sessions over the week, we will see adjustments on those prices. I think this is all from my side. Again, if you want to go to details, see the last news, read the last comments from the central bankers, and also everything else, you got the comments right there on our blog, ATFX Connect blog, Market Snack section. Open there, take a good read, and if you want to actually feed yourself with good macroeconomical content and data information, this is the right place, because I'm reading all and summarizing for you every single morning. Take care, good luck, and if you like this content, please give me a thumb up and subscribe. Bye bye.